What's going on, guys? In this video, I'm going to share with you the truth about investing with safes. In this video, I'm not only going to talk about what a safe is, but how it works, the good, the bad, the ugly, the red flags you have to watch out for so you don't get screwed over. And make sure you watch this video until the very end because I'm going to share some of the most frequently asked questions about safe contracts. Now, I'm going to answer these questions from the perspective of both the entrepreneur who's raised close to $1 million through safe contracts and also the investor who's invested in over a dozen different startup companies using the safe. Now, before we get started, make sure you invest in the like button. It's right down there below this video. Make sure you invest in the like button and subscribe to the channel if you haven't done so already. I really appreciate it. Let's go ahead and dive right into the video. What is a safe? A safe is an acronym for a simple agreement for future equity. What this means is you're basically giving up cash now in exchange for a contract that gives the investor the right to convert their investment into equity in the future. So basically you're investing in a contract, a legal contract with the company, and the investor is exchanging cash for this contract that will be some version of equity in the future. So you don't own equity now. One thing that a safe definitely is not, it's not a loan, meaning there's no debt associated to it. So you don't have to pay it back if you're the entrepreneur from a legal perspective. And it's also not equity yet. It will become equity based on a few different things that we're about to talk about. So how does a safe actually work? If you're the startup investor and you invest through a safe contract, what actually triggers this function to become equity in the future? So there's four main parts to an actual safe contract. And normally a safe is only a few pages. It's a legal document. So it's actually not very long. And in it, you'll find four different sections. And one of them, the most important when it comes to the terms here, is what is the trigger event? So basically, you have to have some kind of a qualified financing in the future. So normally the startup will have to raise an additional round of funding to convert your contract into equity at the terms of the future fundraise. So for example, if you invest in a company with a $10 million safe valuation cap, we'll talk about what that means in just a second. A qualified financing just means that there's a specific amount of money that has been raised in a future round of funding that will actually trigger all of the safe holders to convert into equity. So this could be $500,000, $1 million, whatever it is. It depends on the terms in the safe contract. And normally this amount will actually be relatively low compared to the ambitions of the startup and how much money they want to raise in the future. So it might be a $1 million minimum to trigger this conversion into equity, but the overall round might be $5 million or $10 million. And the reason why you have this qualified financing event, this trigger event, is because you want the company to be able to continue raise financing as they need it, but maybe it's not a full price round in the future. And so to do that, raising, $50,000 here, $100,000 there, $500,000 there, and not actually trigger the event and trigger all of the different safe holders prematurely. So it's actually a good thing to have some kind of a trigger event. And this liquidity event could actually be an IPO or a sale of the company. It doesn't have to be a future financing round. It could be funding round. It could be an actual acquisition event. And basically the safe holder is normally going to get the equity terms just like the future investor or whatever the IPO is or the acquisition or something like that. Now that's in contingency with whatever these other terms are. So oftentimes on a safe, you're going to see something called a valuation cap. And a valuation cap is simply the maximum valuation at this trigger event. So here's a very basic example. Let's say there's a $50,000 investment, even from an individual, or it could be from a number of people. So maybe it was, $500 from 1,000 people, and that's how you get $50,000. But basically, 100 people. That's how we get to $50,000. So let's say they invest with zero valuation cap, and then in the future, the company grows really, really fast, and now the company is raising at a $100 million valuation. So you can imagine $50,000 converting at a $100 million valuation. That could be, 5 years from now. They're going to get diluted to barely any ownership, and they're not really getting any benefit of being an early investor. So the valuation cap is designed to protect the startup investor because they're taking on that unnecessary risk at the very beginning, at the earliest stages where the highest amount of risk for failure. And because of that, you're basically going to protect them with a valuation cap. And so that same example, $50,000 at a $1 million valuation cap, you can see how $50,000 is 5% of a 1 million as opposed to, 0.05 or 0.5%. So significant ownership with a valuation cap versus not having a valuation cap. Same can be applied if it was a $10 million valuation cap or a $20 million valuation cap. You can see how these numbers play in effect. Basically, the valuation cap is designed to protect the early stage investor so they don't get crazy diluted from a very high valuation in the future. So very important to have some kind of valuation cap. Oftentimes, you'll also see a discount rate. You might see a valuation cap and a discount rate or just a discount rate. Basically, a discount rate works similar to a valuation cap. You're basically giving some kind of a discount to the early investor for taking that initial risk in the company. And basically that gives the safe holder a discount off of what the future investors will pay. So here's an example. Let's say it's a $50,000 investment at the $10 million valuation cap, but then there's also a 20 or 80% discount being applied, meaning instead of 10 million, we're talking 8 million because we're gonna take 20% off of that. So the future round of funding, the investors will invest at a 10 million valuation, but you're getting a 20% discount off of that. And again, the valuation cap and discount rate can work together, or you can just have one of these terms. And the fourth thing that you're gonna see in a safe is something called pro-rata rights. Now, this isn't always included, but basically what this is saying is it gives the safe holder the opportunity, the right to invest in those future rounds of funding to maintain their ownership position. And oftentimes, safes will actually not include this for smaller investors to make things a little bit easier as the company begins to grow and mature. Because quite frankly, if you're investing $500 in a startup, it's unlikely you're going to invest in a future round and contribute $500,000 or $5 million. If you invest $500, that's probably all you got. So this is really designed for a bigger investor to protect them and give them the opportunity to keep investing. Oftentimes, the minimum is set at $25,000. Pretty common in my company. We've done a few different rounds with different valuation caps of safes. And we've always had a $25,000 minimum for the pro-rata rights. So those investors, if we choose to do a price round, can contribute at the new valuation and continue to maintain their ownership level and not actually be diluted. So you might be thinking to yourself, as the investor or the entrepreneur, why would you use a safe in the first place? Well, a couple of reasons. There's two problems when you're trying to invest in an early stage company. The first is trying to figure out what the valuation is. And basically when you use a safe, you're just kicking that question down the road when there's more traction to speak for on the company. It's more well-defined. A lot of the risks have been removed. I actually made a video on how you actually determine what the valuation is or what the valuation cap should be or of a startup. I'll make sure that is popped up right here somewhere. So make sure you check out that video. The second problem that a safe addresses is the time and money needed to create legal documents. So oftentimes more sophisticated investors will want to have fancy terms and they want to negotiate different things. And with a safe, you don't really need to do that. Basically, it's a simple agreement for future equity. So the whole point of this is to keep things simple and to move really fast. And that translates into why safes are so good for both the entrepreneur and the investor. They're cheap and they're fast. They're cheap from a time perspective and a legal perspective and an accounting perspective. Because oftentimes these are so well formatted, you don't have to create this from scratch. It's very obvious what it is. You can go online, you can find a lot of good resources, and it's very fast to implement. Also, when you think about it from a cost-benefit analysis, if you're raising on a safe versus a convertible note, thinking about the entrepreneur, convertible notes often have some type of maturity date, right? It's a loan. So if you're the entrepreneur and you're raising money, it's a lot easier to have a safe, basically something that's not going to become debt. It's not going to become a loan. Whereas if you have a convertible note, there's some time pressure associated to it because it might have a 2-year maturity and you have to raise another round of funding within 2 years, or else you have to go back to the investors and you have to renegotiate the terms and ask for an extension. So it's a lot messier and you don't have to deal with that with a safe. So that's why a safe is great. And also it is becoming the standard. It's become a standard for the last 5 to 10 years for early stage technology companies. You don't have to set the valuation, just set a reasonable valuation cap and then keep growing the business, raise the funding. And it's a regulation crowdfunding standard. If you go to sites like WeFunder, Republic, or Start Engine, a lot of companies are raising on a safe. So it's become pretty normal and really best practices have been applied. Now, what about the bad? Well, there's a few different things to keep an eye on. So there is so much uncertainty around the valuation. And so when you make an investment as the investor, you really have no idea how much ownership stake you're actually going to get. Now, if the company is growing and the valuation cap was reasonable, you can make a reasonable assumption if the company is successful and continues to grow, then you can convert your ownership at the valuation cap because they're gonna raise money at a valuation above the valuation cap. That's what you want. So that is one way to address this. It's not really not that big of a deal. If the company does well, great, assume the valuation cap. If the company does bad, well then it was a bad investment and the investment's probably going to zero anyway. So you don't really need to lose sleep over that, in my opinion. And also it's bad because old school investors have trouble understanding a safe. And I made this video hopefully to help address some of these questions that people have. But fundamentally, there are old school investors who have been doing this for 20, 30, 40 years, and they're used to doing a price round and they know exactly how much ownership they own in a company. And so the concept of a future equity is a little confusing to them and they don't like it. But luckily, they're basically just being left behind all of the good deals and they're being forced to learn. Hopefully this video is one way of doing that. So shout out for the new guns. Hit a like on this video if you want to be a part of the new innovation and party. And finally, it becomes hard to manage your portfolio if you don't know exactly how much ownership stake you have. So this maybe goes back to if you have a fund or you're really doing this professionally as like your full-time job, where it's hard to know like, okay, what is the actual value of all of my investments at any given time if a lot of your safe contracts haven't converted into formal equity positions yet. Again, these are pretty minor in my opinion. You can really work around them and it really benefits the entrepreneur to raise money cheap, fast, and not have any time pressure of a convertible note. What are some red flags that you need to pay attention to if you are thinking about investing in a company that is using a safe? So the number one red flag is the valuation cap is way too high, or there's no valuation cap. Basically, you're investing in a company that could be worth $1 billion tomorrow, and your $100, $500, or heck, $100,000 investment will be pretty much worthless if you convert at like $1 billion. So if there's no valuation cap, or it's ridiculously high, like a company that's basically just an idea, maybe they've got a website, they've got no revenue, and they're raising at $100 million valuation. If it's Elon Musk or some other superstar entrepreneur raising funds, invest in the company. Otherwise, you want to stay away from companies that just have an absurdly high valuation cap, because even if the company is successful, you're not really going to see much of a return, because if it had a $500 million valuation cap and the company becomes $1 billion, you'd be lucky to double your money. So not really that great. Second red flag is if there are complicated terms. Again, a simple agreement for future equity is supposed to be simple. So if there's all these different provisions and it takes time for the entrepreneur to try and explain, and there's side letters and all this stuff, those are some red flags. You want to keep things as simple as possible if you're the entrepreneur and you're the investor. And then the third here is there's no transparency of prior funding and prior terms. So if a startup is raising on a safe, they should say they've already raised X amount of dollars, and you can look at their Form C if they raise online. How much money have they raised using safes before? What were the terms of those safes? Are you getting the same safe as other investors? You shouldn't be getting anything differently, unless there's certain circumstances, which goes back to keeping it simple and not having complicated terms. So you don't want complicated terms, keep it simple. And the fourth red flag here is how much has been raised over time. This is really important. A lot of people don't think about it. If the company has been raising safes with a $3 million valuation cap, next thing you know, they raise $1 million. Then they raise another $1 million on safes with a $3 million cap. Then they raise another $500,000. Well, basically, they essentially filled out their whole cap table, and they're not able to raise any more money in the future. And the founders were diluted to basically owning none of the company. So it doesn't really make any sense for you as the investor and the entrepreneur to continue building the business, because the terms didn't make any sense and they continue to raise so much money. So it's so important. That's a huge red flag about how much money has actually been raised and if it makes sense with the valuation cap. That's the only time it makes sense for the valuation cap to be relatively high. Maybe it's a 50 million valuation cap, but they're able to raise $10 million. That actually wouldn't be that big of a deal. If it's a $50 million valuation cap and the company is raising $1 million, probably a problem. If the company is raising $5 million, on an 8 million valuation cap, that's more than half of the company just in safe contracts. It doesn't really make any sense. Now, finally, I want to talk about the frequently asked questions that I get time and time again here on this channel, in email and LinkedIn DMs, all that stuff. If you guys want to follow me on social media, make sure you're part of the family there. Happy to connect with all of you guys. But let's go ahead and got my iPad right here. Let's go right into it. First frequently asked question is, how is a safe different from a convertible note? Basically, one is debt and one is not. Convertible note is something that will convert into a debt instrument, meaning there's a maturity timeline on it, there's interest, kind of like a loan from the bank. And oftentimes the entrepreneur doesn't really want that because they don't want to have to deal with some debt on their balance sheet. And also the investor doesn't really like that either because they don't want a loan. They're not a bank. The investor is trying to invest startup capital so that the business can grow very, very quickly. They don't want their money back with interest. They want their money back with a multiple of 5, 10, 100x or more. So that's a big difference. One is debt and one is not debt. A safe is not a debt instrument. It is not a loan. It will never convert. And anytime you see someone say a safe note or you see safe note, they don't know what they're talking about. Safes are not debt and they never will be unless the terms are different, and in which case it would be a convertible note. Second question, do you have to pay taxes? So here's a great one. Safe investments are not taxable transactions, and that the future conversion to equity upon a triggering event is also not a taxable transaction. And basically the consensus is that the purchase price for the safe is rolled over as basis into the future equity. However, the IRS has not issued definitive guidance. You can tell I copied and pasted that. Basically, this video is for entertainment purposes only, and make sure you do your own due diligence before making any investment decision. But yeah, you don't have to pay taxes when you make a safe investment. Another common question is, can you cash out? How do you get your money out? And so if you have a safe contract, you technically have no way to actually cash out your investment. So make sure when you invest, when you invest in a safe contract, you're committed for the next 5 to 10 years. Now, when the company raises another round of financing, there might be an opportunity in the secondary market or through a private placement where you can actually sell to a future investor and get some or all of your money out at a return. It could be positive or negative, actually. So make sure you pay attention to what the long-term horizon that you have is for this potential investment opportunity. Another question, what happens if the startup dissolves the business before the liquidity event? So they never go public, they never get bought, they never raise more money, and the company is shutting down. That's actually something that happens pretty often. And basically the safe holders may receive their investment back with interest or without interest prior to any distribution of company stockholders if the cash is available. What that basically means is that the company is running out of money, they got to shut down, they decide to shut down, there's a few $100,000 left in the bank, they're going to pay out the safe holders to some level before the founders get any of the money when they close the company. So the safe holders will get the money first. Most likely it will actually come after the professional investors that raised in a price round, if there was a price round of financing. Keep that in mind. And then finally, who speaks on behalf of all of the safe holders? So, you don't really have any rights as a safe holder. You can't vote in the company's board meetings or really do anything. So who represents you? And there's always going to be some kind of a lead investor. I didn't mention it because it's pretty minor as to how a safe contract works. But you're going to have a lead investor, and they are responsible to speak on behalf of all the investors. If you invest through an equity crowdfunding round or something like that, and there's thousands of investors, you're going to have one lead investor, and that's going to be the point person that communicates directly with the CEO. Sometimes in a safe contract, the CEO actually becomes the lead investor. And so in our case, that's actually what it is. So voting power basically just goes to the CEO. And that actually keeps things simple, so that way you don't have people trying to meddle in how the business is operating. But there normally is a lead investor that is, the representative for all the other investors. And so that wraps up our Q&A. I hope you guys enjoyed this video. Make sure you subscribe to the channel, like the video. Let me know what questions you have down below in the comments. Would love to help you guys. And any other resources that have to do with investing in startups, entrepreneurship, I'm gonna leave them down below in the description of this video. I wish you guys the very best. Happy investing and have a great day. Keep hustling.